I don't think we're going to see the same level of stock market capitalization to GDP in the United States for a very, very
Right.
long time. That'd be my base case. So the level that we reached of over 200%, say Wilshire 5,000 compared to the GDP, I think we've hit a high watermark there that it'd be very hard to beat going forward. Maybe we get near matching it, but I think it'd be very hard to just kind of break past that and go higher. And that's because we had kind of perfect conditions. So we had structurally falling rates for a long time. Then you had central bank accommodation (QE), and then you had the biggest ever, or at least since the 1940s, the biggest ever fiscal injection into the market, and it took a while for that to show up as price inflation. So at first, it just kind of went straight to asset prices, and so I think when you have all those things combined, that was a high watermark. Another way of characterizing that is if you look at the household net worth, U.S. household net worth as a ratio of GDP. Usually that's some low multiple. During the dot-com bubble, you got as high as 4.5. Then it came back down, and then during the subprime mortgage crisis, right before that, the housing bubble, you got back up to around 4.5, and then came back down. And this time it get as high as 6, because we had high house prices, high stock prices, high bond prices. Everything was pretty high, and that level of household net worth of being 6 times
Yeah.
GDP, I think again that's a pretty high watermark that's very trouble to match going forward. And in an environment where commodities are super cheap, and Alf touched on this, you can have a rather financialized economy. If you have low rates, plenty of accommodation, commodities are abundant, you basically you get this high wealth effect. Whereas if we enter a world, and I think we are, where we're in more of a commodity-centric decade, where commodities and specifically energy are some of the bottlenecks for growth, I think it's hard to have the economy be as financialized as it reached at that high watermark. So I think if you look out long enough, just because stock markets are measured in nominal terms, I think they'll eventually grind to higher highs. Looking at the major indices, I don't really have a strong opinion how long that takes. Again, that's partially comes down to policymaker opinions. I would say that in say inflation adjusted terms or in ratio to GDP terms, I think it's gonna be pretty challenging to really push to higher highs in those metrics. So I think looking at the PMI cycle and its various leading components is an important thing to look at, as well as a shift in Fed policy. But the way that I generally manage a portfolio is more about shifting around the margins rather than like in or out. And so what I mean by that is, for example, when there's evidence of excess in terms of valuations and equity euphoria and high sentiment, and then economic conditions are rolling over, that's when I take some chips off the table. I don't just sell everything and go all to cash, try to time the top, but I pull back on some of my risk. And then if we see a significant decline in a number of asset prices, some more than others, I then start putting some chips back on the table in those things that I think are still long-term attractive, even if I think we might or may not be near a bottom yet. And so, we recently saw kind of a spike in bear sentiment, so it's natural you're going to get a bear market rally. And rather than try to predict really how far that's going to go, I kind of do that risk on, risk off approach around the margins. But I generally agree that I think that earnings are going to be choppy for a long time,
Hmm.
and I think that we're not out of the woods yet in terms of this economic slowdown. I think the Fed is still trying to curtail demand as much as they can. Um, we're seeing a yield curve inversion. We're not seeing accommodative Fed policy, and we don't see the bottom in these various kind of forward-looking indicators. So I would keep an eye on that before taking on more significant risk. So I think we're seeing there's actually been a number of papers about this. The ECB's written about it as well. Generally, policymakers, where possible, would like to reduce or eliminate the uses of cash, because the more that they can get into electronic payment systems, there's a couple perks. One is the banking system makes money on it. So if you use your card, they get a cut, whereas they don't get a cut from cash. But then two, it means that there's more surveillance and kind of control options, right? So kind of the logical conclusion of that is the CBDC, um,
Yeah.
uh, where they can basically make programmable money. They could do stimulus that can only be spent on certain categories, for example. Um, and so I think that's the general trend that policymakers want to go. And then the question is how do we see that kind of in the public? So, for example, we've seen kind of rising pushback in a number of countries, kind of populist pushback against some of these policies that they perceive as overreach. So, for example, we've seen it among farmers, we've seen it among truckers, whatever the case may be. And so, it could be interesting to see if they end up, kind of pushing this cash thing too far, or and then you get some sort of pushback. I think it's going to depend on a
Mm.
country by country basis, but I think the digitization of payments is probably going to continue. And there's a couple different vectors that it happens in. So there's the top-down approach, kind of get more of it going through the banking system, get more of it going into potentially a CBDC. And the other hand, you have things like Bitcoin Lightning Network, stable coins, that provide this more open network, and it becomes kind of that dance between what people want to use and what regulators want to deal with. I think similar to how we got what I view as the highs in stock market capitalization to GDP in the United States, and household net worth as a percentage of GDP. I think that generally the household value to median income is also kind of a pretty high watermark. Doesn't mean we can't touch it or stay here for a while, but I think it's hard to just keep grinding higher from here, because I think we've already kind of hit the bottom in terms of interest rates and pro-accommodative policy. Uh, Now that can, if that comes back down to say 7 or 6, that could mean that house prices fall, or it could mean that house prices chop sideways for a while, as
Right.
as nominal incomes, largely due to
Right.
the inflation component, catch up. And I think that some combination of both could occur. You could have a mild reduction in housing prices and a grinding higher in nominal wages. Um, I think that the kind of the bigger picture trend of this, I think, is that we've just, for decades now been in a very weak money environment, so negative real rates, in many cases,
Yes.
and that the result of that is that you monetize other things that you perceive, usually rightly, as being more scarce. And so, for example, people monetize the stock market, meaning that they use their 401k, their S&P 500, as long-term savings. They just throw money in it every single week because that's their pool of long-term savings. Same thing for real estate, right? So if you perceive money as super weak, you're more likely to buy a second home, you're more likely to pay up for a home, because you're using those physical goods as a giant savings battery. And so, in an environment, if you go back long
Mm.
enough, say when you had gold standard or something like that, you'd see less monetization usually of these other things, because the underlying money is good enough for savings. Whereas when we have this environment where no one is really expecting to get a positive real return on their bank cash or their treasuries long term, they end up monetizing other things. And I think we've kind of hit the peak level of that, due to kind of this the long term debt cycle that we're in, and the fact that we kind of hit rock bottom in terms of rates, even negative rates in many places. I think it's hard to go lower than we went, in those things, even though we could go back down and kind of match those for periods of time.